to delve a little deeper now into break-even analysis. And that'll pretty much take us right through to the end of the chapter. Everything we do from here on in builds on what we do here in this video. So on this one, you may want to really pay attention to every step that I take, because everything after this builds. So let's review. Sales minus variable costs equal contribution margin, minus our fixed costs equals our operating profit. That's the simplicity of the contribution format that we've presented so far. So let's take this and just rearrange some terms. We're not going to get fancy. We're just going to state things differently. So if we start from sales and end with profit, clearly profit is a result of a few other things. We're going to develop something here called the equation method now. So let's start with profit. Profit must equal sales minus variable costs minus fixed costs. That's nice and simple, isn't it? That's step one. We've taken one step towards the equation. Well, let's put sales on the other side now. Sales equals profit plus variable costs plus fixed costs. Now, all I've done here was just algebraically rearrange the profit equation. So what we can say now is that at break even, profit equals zero. So at break even, if profit equals zero, sales will equal variable costs plus fixed costs. Let's prove that. Let's take an example. Let's say we have something with a selling price of $250. We'll also use the percentage format for this as well. Let's call sales 100%. Let's say our variable cost per unit is $150, which is 60%. That's our variable expense ratio, remember? That would leave us with a 40% contribution margin. Let's put our fixed costs at $35,000, and let's work with the sales equals profit plus variable cost plus fixed cost. So our sales are $250 per unit times how many units we sell, 250Q. Our variable costs are $150 a unit times how many units we sell, which is 150Q. Our fixed costs are $35,000. And we're going to assume profit equals zero to figure out our break even. So we're going to make profit equal to zero. There we go. We can pretty much drop that plus zero, by the way. That gives us 250Q equal to 150Q plus 35,000. That would give us our break-even level in quantity. So let's algebraically solve this. 100Q equals 35,000. Q equals 350 units. So if we sell 350 units at $250 and they do cost us $150 to produce and our fixed costs are $35,000, we will make zero profit. So selling price equals $250. So $250 times those 350 units for break-even will give us $87,500. So now we've derived our break-even in units and our break-even in sales dollars. Isn't that nice? We could also have worked with the percentages instead of the dollar amounts. Instead of the 250 and the 150, we could have worked with this. We could have recognized that X, will let X equal sales. So 100% of sales, in other words, X equals 0.6, 60%, right? 0.6X plus 35,000. So X is your sales. Your variable expense ratio is 60% of sales, so it's 0.6X. That gives us 0.4X equal to 35,000, or 35,000 divided by 0.4 equaling $87,500. There's our break-even amount in sales, because we let X equal sales, right? Our selling price is $250. We take our break-even in sales, which is $87,500. We divide it by our selling price, and that'll give us the number of units for break-even. Notice that this gives us the same answer if we start from dollar amounts or if we start from percentages. We get the same answer. That's the equation method. That's a really long way to do it. and complicated. Let me show you the formula method. Let me show you how fast and how simple this is. And once I show you the formula method, you'll look at the equation method and say, why should I do that? Well, here's the deal. Understand the equation method because you may have to work with it. So, fixed costs divided by contribution margin per unit will give us our break-even in units. All we do is we take our fixed costs and we divide it by the contribution margin for every unit we sell. So $35,000, our contribution margin is $100 per unit. We get 350 units. This is the same as 100Q equals 35,000. Our fixed cost divided by our contribution margin ratio will give us our break-even in dollars. Let's try that. Our fixed costs are $35,000. Our contribution margin ratio is 0.4 because our variable expense ratio is 0.6. There you go. There's our 0.4. And that will give us 87,500. So we just have to remember two little formulas. And we don't really have to remember anything because they both have fixed cost in the numerator. Now, that was break even. But what if we want a certain target profit? What if we say, look, it's not enough to break even. I want to make $20,000 in profit. Now, what are my level of sales and number of units I need to achieve that? So, let's reprint our example here on this screen. Selling price, $250. We'll call that 100%. We'll call our variable cost per unit was $150. Which was 60%. 150 is 60% of 250. That gives us our contribution margin per unit of $100 or a contribution margin ratio of 40%. And our fixed costs are still $35,000. So let's work with the equation method first, and then we'll go to the formula method. Now in the equation method, you'll recall that at break even, we had 250Q equal to 150Q plus 35,000. That's break even. To consider target profit, let's just add one more thing. There's our 35,000 plus, let's just add one more thing, plus whatever target profit we want to make. There's our break even, and then add our target profit. So once we know how many units we need for break even, we just got to figure out how many more units to get to the target profit. So we just add it to fixed costs and say, well, let's just make it part of fixed costs, right? So let's say we want 40,000 in total profit. Or sorry, target profit. Let's say we want $40,000 in target profit. Here's what we do. 250Q equals 150Q, our variable costs, plus $35,000, our fixed costs, plus $40,000, our target profit. There we go. And all we need to do now is solve for Q. 100Q equals 75,000. Q will equal 750 units. If we sell 750 units, there's our target profit of 40,000. So 750 units times $250 a piece equals $187,500 in sales. And there's our target in quantity and our target in sales. We'd have to hit those levels to get 40,000. Now let's do it faster. Let's do the formula method. You'll find that this is nice and easy. We only really need two things, right? You need your fixed cost and your contribution margin per unit or your contribution margin ratio. So fixed costs, and then we'll add our target profit. And we'll still divide it by our contribution margin per unit. So this $35,000 is our fixed costs. Add the 40,000 target profit that we want and divide all that by the contribution margin per unit, and it'll tell you how many units we need to sell. That each unit contributes $100, so we got to sell 750 of them to get to 75,000. If we divide this instead by a contribution margin ratio, it's the same numerator, 35,000 plus 40,000, but our ratio is 0.4. That gives us 187,500 in sales. So if you're comfortable with the equation method, okay. If you're comfortable with the formula method, okay. They both give you the same thing. One final note before we go. Life has a certain reality, and it's called tax. What about tax? Well, let's figure out where tax comes from. Let's start with earnings before tax. And that's what we've been doing. Our target profit, by the way, that we've done so far, has been earnings before tax, EBT. But let's say our tax is 20%. If our tax is 20%, that means our net income, our after-tax income, must be 80% of the earnings before tax. So there's T, and this is 1 minus T, right? So if we multiply earnings before tax by 1 minus the tax rate, we'll get our net income. So take earnings before tax, multiply it by 1 minus T. That'll give us 80%, right? 80% of our earnings before tax is our net income because our tax is 20%. Well, let's just rearrange it. This is just algebra. Earnings before tax is net income, 1 minus the tax rate. Yeah, that's nice and simple, right? So let's say we want $40,000 after tax. There it is right there. I just extended the line down. Here's how we write it. Our fixed cost plus our target profit over our contribution margin per unit. But now our target profit is after tax, so it's our fixed cost plus, let's substitute our net income divided by 1 minus the tax rate in for target profit divided by contribution margin per unit. And substitute in the numbers. Let's assume that we have let's go with a 30% tax rate. So it's 35,000 plus 40,000 divided by 1 minus 0.3 over 100. And now all we have to do is simply just solve it. We get 921.43. And this is a good lesson so far. When we have an odd number like this for units, round it up. Go to 922. So let's take our 922, multiply it by our selling price of $250, and that'll give us $230,500. That's our break even in sales. So target profit really isn't that much more difficult after tax than it is before tax.